In this video, I'm going to talk about 3 things that retired investors need in their portfolios, in their investment accounts. Okay, the very first thing that retirees need in their investment accounts is risk management. Sounds boring, right? But risk management can take different forms. Let me cover those since the best retirement portfolios have risk management in place, and it's something that becomes super important during retirement because we just don't have that income and that time to make up losses. Okay, so first, risk management can be achieved by allocating a portion of the portfolio to an asset that is non-correlated with stocks. Now, yes, I'm making an assumption here that everybody owns stocks because, well, almost all investors do own stocks. So I'm going to say assume you're a stock investor, and this risk management occurs by allocating a portion of your investment dollars to assets that are non-correlated to the stock market. Now, non-correlated is just a complicated sounding word for meaning they move in opposite directions. The expectation with this is that when stocks go down, another asset that you own is going to go up, and it will reduce your overall portfolio risk. This is called strategic portfolio management. I've done some other videos on this with more detail. Traditionally, in the United States, this asset that's been used is U.S. Treasury bonds, and that's because over the past few decades, U.S. Treasury bonds have almost always gone up when stocks have gone down during bear markets. I do want to mention here, it's really important, the facts are that stocks and bonds were correlated more often than not. In other words, they went up and down at the same time, more often than not, prior to the 1990s. Yep, that's a fact. Okay, so I've done another entire video on this, which you can check out. Now, you may remember we saw stocks and bonds move together in 2022. That was after I did that video saying that sometimes stocks and bonds both go down at the same time. Okay, I got arguments in the comments. They do. Okay, so they did it together. Stocks and bonds both went down in 2022. And investors were shocked because we've been taught, I was taught in my studies, when stocks go down, bonds will go up because investors flock to the safety of bonds. And yes, that does sometimes happen. But there's also the fact that sometimes stocks and bonds go down together. So this isn't always a risk management strategy. Nevertheless, the best retirement portfolios have got to have some risk management in place because we can't afford that loss in retirement. Not only can we not stomach huge losses in retirement in our overall portfolio, but financially it just is too much of a setback at that time in our life. So owning something that goes up when stocks go down, if you're a stock investor, is super important. Now, how do I personally handle this? I've grappled with it for a long time. And finally, several years ago, I started using a portfolio that rotates into various asset classes based on long-term trends. It rotates out of asset classes and into other asset classes. So it'll rotate out of something that's going down and it'll rotate into things that are going up. And that's how I manage the risk in our portfolio. So I might rotate out of stocks, or at least a good portion out of stocks and into bonds, or maybe even into cash or commodities or something else. And that's how I handle it. I rotate rather than having that fixed asset allocation. I've explained all this in more detail in my Allocate Smartly review video. That's the product I use to help me with all this. And you can check that out if you want. I'll try to remember to put a link to it in the description section, and I'll try to remember to put a link in the comments. Okay, so let's move to the next thing that the best retirement portfolios have. Okay, and that is income. Everybody in retirement wants income. We need that income because our job income is gone. Okay. Retirees can actually have a large amount of capital. A lot of retirees have a large amount of capital, but they're making little income from that capital and they can't support their lifestyles. Now, this has gotten a little bit better lately because interest rates a money market or over 5%, yaha, or yippee, or whatever, which is fantastic. But that for years, the interest income on money markets was negative after inflation, or it was 1%, maybe 2%. Even bonds were yielding very, very low amounts. So it's gotten a little bit better in the last year or two. This situation of having investment capital and no income has led to just the wildly popular, just the norm for retirement planning, and that's to make withdrawals every year from your hard-earned savings and spending down that investment capital every year, hoping and planning for it to run out when you die. I mean, that is basic retirement planning, okay? That's how it works. So instead of investing in assets that generate income. So what I like to do is invest in assets that generate income, or use strategies that generate income instead of, or in addition to, or for now, for the next maybe decade or so, using that income that's generated from the assets. And then later on, if we want to draw down, take that traditional retirement, then we can. I've talked a lot about this in other videos. In fact, I recently did a video specifically on how to generate income, more income from stocks and bonds. If you want to take a look at that video, you can check that out. Now, let me circle back for a second to the income that we're getting now from traditional retirement accounts for most people. Okay, so the S&P 500, the yield on it, remember the yield is how much dividend income you're getting. That's more of a sure thing than the potential capital gains, okay? The yield is about 1.3% as of this recording. That is for the S&P 500. Now, a popular U.S. Treasury bond fund, which is IEF, that's intermediate treasuries, intermediate sort of long-term treasuries, it yields a little over 4% as of this recording. Now, this sounds pretty good, right? Sounds pretty good, but then if we consider inflation at the historical level of 3%, that's the average long-term, well, it's hard for me to get excited about a real yield of 1%, right? Where are we going to go with that? Like, it sounds pretty good. Oh, I'm getting 4% for my, IEF, my Treasury fund ETF. But it's really 1% after inflation. Of course, the dividend yield on the S&P 500 would be totally negative if we considered inflation. So this means investors have to get really creative in generating income from retirement portfolios. But that's what we need. That's what the best retirement portfolios have. They have income because this is when we need the income. And there's one more thing I want to say about this. There's so much focus on stocks and bonds because that's where all the money is, in getting investors to put their money in stocks and bonds. But there are also alternative investments such as real estate, such as, real property and other assets that can be used to generate income from investments. So the only way to do this, accomplish this, isn't just from having stocks and bonds. Okay. So the third thing that the best retirement portfolios have is inflation protection. Now, I've touched upon this already just a little bit, but the best retirement portfolios also have some sort of inflation protection. We talked about risk management and we talked about income, but what about inflation? Okay, so we talked about how inflation is eating away on our yields, but we need to protect ourselves from that somehow. The most popular investment to do this with is TIPS bonds because those are just super easy to purchase through an ETF or something like that. It's my opinion, though, my own opinion, and I apply this to our investing. It makes no sense to own TIPS unless it's the right time to own TIPS. I rotate into asset classes when it makes sense to own them versus just buying them because we should own them because, well, one day inflation might happen again and 20 years later it does. And in the meantime, we wasted our capital in TIPS. So you can check out that video, the Allocate Smartly review, if you want to know more about how I do this. But it is important to own something that will protect us from inflation over the years, even if we just have average inflation it's 3%. That is the long-term average for inflation is about 3%. We know it's been really pretty nasty the last 2 or 3 years. I don't know what it will be moving forward. I just don't know that, but I do know that we have to, if we're living in retirement without income that is adjusted for inflation as many salaries are, then we have to have something that's going to protect us from that. Now, I mentioned tips. Another thing that we've done and is owning real estate rentals, because real estate rentals are a way to hedge against inflation. And of course, the portfolio strategy that I use rotates into those tips whenever it makes sense to do so. I want to mention, super important, I'm not suggesting it's the right time to do any of these things. I've mentioned I rotate our portfolios. Anything I talk about here is just based on my own experience. It's not advice. There are good times and bad times to own all asset classes as far as I'm concerned, based on risk management and the macroeconomic factors at any given time. Whatever you do, just remember to retire certain.